Hey, good morning, everyone. Welcome to our YouTube channel. Hope everyone is doing well. It is Wednesday, May 10th. I hope everyone had a good morning here today to start off with. And the main point of data that we're going to be talking about is inflation, naturally, right? The CPI report came out today. This was a much anticipated April consumer price index figure that a lot of traders and investors were waiting for, right? Monday, Tuesday, markets were flat, low volume. And naturally, we were expecting to see a lighter inflation number, right? And the expected year over year was 5%. Remember, the Fed's goal is 2%. They want to see prices march towards that 2%. March CPI showed inflation receding for the ninth straight month after the Federal Reserve awoke from the reality of high prices and began hiking March of last year, right? So uh, today, right, CPI was expected at 5% year over year, right? That's the year over year figure. Came out at 4.9% year over year, which is a slight little push to the downside, causing markets to rally, this pre-market rally that we were looking at with our trading room this morning. So we talk about numbers in March, 5.6% year over year. Now April, 4.9% year over year, right? Very, very large year over year monthly drops here. And inflation has ebbed from its peak of 9.1% last summer, but remains fairly well above that 2% Fed target, right? Obviously, we have to look at the PCE numbers. The PCE is the Fed's favorite reading. We have the PCE before the next rate hike. We also have tomorrow, we have PPI numbers, which will give us a little more insight on that as well. So April numbers, again, came out on a large drop, and that is realistically what the Fed would want to see in its attempt to pause rates. So now, the probability of that Fed actually pausing rates increased drastically from this most recent event. If we go to cmegroup.com, right, you can check what the expected probabilities are of the rate hikes, cuts, right, whatever it is. And realistically, right now, we're sitting at about 89%, or sorry, 86% of the 86% chance that we're going to keep rates as is in the coming June 14th meeting. So Fed seems, or I guess investors and speculators see that the Fed is happy about this and seeing that this hiking cycle might be coming to an end. Another pretty big consideration is that as the Fed shifts to a meeting by meeting approach for its rate decision and insists that the data will inform those choices, each economic data point could spark some kind of market volatility. Realistically, the CPI swaps market forecasts a significant drop in inflation between now and June, and the year-over-year change falling to around 3% and remaining to about 3 to 3.5% by the end of the year. So this would mean that we're on course for that to happen. Realistically, if we remain above that 2% inflation expectation from the Fed, we're probably not going to see rate hikes, rate cuts commence this year. I think that some bond markets are pricing that in, but realistically, I think that's more of a thing to look at for 2024. You should also consider that the Fed is renewing realistically volatility hitting and banking industries. So the volatility that's coming into the banking industries is something that the Fed is concerned with, not only just the inflation figures, but that is something that they do want to consider in these hiking, cutting cycles. So regional bank stocks continue to kind of fluctuate around on Tuesday as concerns about deposits continue to unnerve the financial sector. And lots of fingers have been pointed at the short sellers putting regional banks under pressure since the collapse of SVB, and has even prompted about whether the SEC should halt short selling of regional banks, and regulators banned short selling on more than 1,000 banking stocks in 2008. So the question is such a drastic move a possible scenario? And I think that could be the case. Now, yesterday, the likes of Goldman Sachs also joined other banks in expectation that we do see heightened volatility into the end of the year and a larger drop in the overall market, pulling down about, I think, the expected 5 to 10% coming into the end of the year. So right now, we're enjoying this endless bid, this continuous buying. Markets, just every chance they get, they rebid, and we're sustaining prices extremely well. So what's happening right now is we're probably going to push into that 4200 area today. I think that the market's really happy about what had happened, and we're going to kind of reevaluate the scenario from there. But right now the bid lives on, and I think there could be a little more upside, especially with tech being super strong. Speaking of tech, industry rivals are watching as Twitter continues to take steps towards becoming an everything app. Elon Musk has revealed a new feature like voice and video chat will be becoming a service, as well as encrypted direct messaging, bringing the platform in line with other social medias, right? Just like or offerings that other social medias have, just like Instagram, WhatsApp, and Facebook or Meta. So in the quest towards becoming a super app, Twitter has recently linked a partnership with eToro that'll let users trade stock and crypto. Though the bigger fish range from payments and shopping and financial services and entertainment is what I think Elon is kind of focusing more towards. Um, Another thing to mention, right? Hedge fund investor Stan Drunkenmiller. Sorry, he's massive figure in the industry, right? So mentioning that there could be a 2008 like recession or even worse, a hard landing likely includes a 20% plus decline in corporate profits, unemployment going above 5%, which is something that Jerome Powell spoke about earlier, and increased bankruptcies. He also explained that 2023 Sohn Investment Conference, it's naive not to be open-minded to something really bad happening. And again, it's not my forecast, but it's as a risk manager, it has become a part of my matrix and the equation to think about regarding stock picks at the conference. So we'll see how that kind of shapes up. I'm under the impression that we have more of a mild pull down and recession than something very drastic that a lot of people are waiting for. They've waited for it. And we could have seen lows for the year, right? We might revisit those lows by the end of the year. But realistically, unless there's some kind of massive catalyst, it doesn't seem likely the way that things are headed, especially with this most recent earnings period, that will be the case. So with that being said, I am looking for some kind of market pullbacks to continue this long side today. 4172 and 4182 are the first resistance points that we do have to keep in mind as the market opens. But closer to the 6058 area would be an area where I would like to see some buyers step in, and maybe 4146. So with that being said, check us out at community.tradeproacademy.com. We're going to be trading this live with our team in Zoom just about when we exit this YouTube live. So if you want to check that out and see how we trade futures live on a daily basis, here's your chance. So I'll see you guys in there. Hope to see you guys in there. And let's wrap up this week on a good note. We have today, tomorrow, and Friday trading days left of the week. So let's make sure it's a good one. So thank you and take care, everyone. Keep in mind, keep watching these, and keep an eye on your email for some really cool updates that are going to happen on YouTube towards the end of the month. So thank you and chat soon.